Welcome to another tutorial video. This one is going to be all about lease accounting, as you can see on screen. Now, we published a video a few years ago about the accounting change that puts operating leases directly on companies' balance sheets as right-of-use assets and lease liabilities, but there still seems to be a lot of confusion over lease accounting on the financial statements and how it affects models and valuations. The main issue with this topic is that in the abstract, in other words, for looking at single leases and answering very specific interview questions, it can be pretty confusing and counterintuitive. But in reality, in real life, in models and valuations for real companies, I think it's actually simpler because you never work with one single lease or two leases or something like that. You're always looking at the numbers in aggregate over dozens or hundreds or thousands of leases, which means that you need to simplify the treatment a little bit and project things in a clear and logical way. This is a longer lesson, so I'm going to start with a very short version of what you need to know about lease accounting. Then we'll go through a full table of contents and go through each of these points in more detail, wrap up with some coverage of valuation and what you should realistically know about for interviews. Let's get started with the short version though. The basic idea is that under the accounting rules that are now in place, companies have to treat leased assets, or at least most leased assets, as if they had purchased those assets using debt. So when the lease is first signed, companies record a right of use or ROU asset and a corresponding lease liability on the liabilities and equity side of the balance sheet. Once that happens, the company then pays the agreed upon annual payment in cash for the lease each year. But for accounting purposes, the company calculates interest, depreciation, and principal repayments for this lease. Even though it's a lease, it's not actually traditional debt. Under IFRS, for non-US based companies, the depreciation stays constant, the interest and principal payments change each year, and the right of use asset and the lease liability both decrease, reaching zero at the end of the lease term. And I have an example here so you can see the treatment under IFRS. We create that initial lease asset and liability in the beginning. We have interest expense each year. This eventually goes to zero by the end. We have depreciation that stays constant, and then we have these principal repayments that keep increasing. And the end result of all of this is that as you go toward the end, year 10 here, the lease asset and lease liability both reach zero at the end when the 10-year term of this lease ends. Under US GAAP, finance leases follow this same treatment, but operating leases are different. Now we'll cover the differences between finance and operating leases in a little bit, but the leases work differently under US GAAP and there are different treatments depending on how the lease is classified. For operating leases, companies record a simple rental expense on the income statement, but confusingly, they still reduce their right-of-use assets and lease liabilities each year with these depreciation and principal repayment line items, even though they're not actually showing them directly on the financial statements. So here is a quick snapshot of how it works under US GAAP for operating leases. We still create the lease asset and liability in the beginning, and they still decrease each year. On the income statement, we have a rental expense that shows up. We're assuming $20 per year in a rental expense here over 10 years, so this appears on the income statement. And we do reflect the changes in these assets and liabilities on the cash flow statement. And behind the scenes, the company does calculate interest, depreciation, and principal repayments, but it doesn't actually show them on the statements for operating leases. So the lease assets and liabilities are decreasing based on numbers that you do not actually see directly on the statements, and that's what makes this topic confusing, in my opinion. That's the short version of what you need to know in a few minutes about leases. Let's now go into the outline for this tutorial. It is on the longer side, and I want to respect your time, so I will give you a table of contents here on screen as well. We'll start off with the differences between operating leases and finance leases, otherwise known as capital leases. Then we'll go into finance leases and operating leases under IFRS and expand on what I just showed you. Then we'll look at the US GAAP treatment of operating leases. We'll go through leases in real life on the 3 statements and in 3 statement projection models. Then we'll look at the valuation impact, the DCF impact, and how equity value and enterprise value are affected by this accounting. And then we'll wrap up by talking a little bit about what you need to know for interviews realistically. So let's start with operating leases versus finance leases, because this is very important to know, especially if you're working with US-based companies. With an operating lease, a company signs a contract to rent a building or equipment or a factory or something else. And it will agree to a fixed annual payment, or maybe a payment that increases each year, but it agrees to a certain payment schedule upfront for a certain number of years. When that period ends, it returns the building or equipment or factory to the owner, the lessor, at the end. With a finance lease, mathematically, we can still have the same terms. So it might still be $20 per year for 10 years, but at the end, there is an ownership transfer option or a bargain purchase option or something else that gives the company the potential for ownership of this asset. There are some other technical criteria that might cause a company to classify a lease as a finance lease, such as the lease's term being at least 75% of the asset's useful life, or the present value of lease payments exceeding 90% of the asset's fair market value, and there are some others here. These are not that important. They're just for your information to understand why operating leases tend to be far more significant and far bigger than finance leases for most companies, simply because you don't need as many criteria to qualify as an operating lease. Let's now go through the IFRS treatment of all leases, both finance leases and operating leases, because everything here applies to both types. We're going to assume the same 10-year lease with $20 of rent per year that I just showed you, and this will be paid in cash by the company each year. When a new lease is signed, the lease liability and lease asset should both increase by about the same amount, and it should be based on the present value of $20 of rent per year for 10 years at an appropriate discount rate. This is normally in line with what the company pays on its secured debt, so we can say 5% here. Let's go to our blank spreadsheet and fill this in. We'll use the NPV function in Excel, which confusingly does not actually calculate the net present value. It actually calculates the present value. We'll take 5% for the discount rate, and then we will take these cash lease payments over 10 years. That's our lease asset. And then for our lease liability, it should just be equal to the lease asset in this simple case. I'll fix the formatting here a little bit as well. I don't like those dollar signs. So these are our initial lease asset and lease liability in this case. Now, each year after that, we have to record components for interest, depreciation, and principal repayments based on a few simple rules. The interest will be equal to the discount rate times the lease liability each year. So initially, it's 5% times 154. Let's go in and enter that. For the lease interest expense in year one, we're going to take the lease liability from the end of the previous year and multiply by the discount rate. We'll anchor the discount rate and then copy this across. And it's blank in all these other years because we still have to fill in the lease liability in those years. The depreciation equals the initial lease asset divided by the lease term, so 154 divided by 10 here. Let's go in and enter that. We'll take the lease asset and divide by the 10, and then this is going to stay constant each year, so we can just link to this, anchor this with F4, and then copy this across. And then finally, the lease principal repayments appear on the cash flow statement, and these will be equal to the cash lease expense that year minus the interest expense that year. So we can go up and take our cash lease payments right here and subtract the interest expense, and this gets us our lease principal repayments. Now, of course, for this math to make sense, we have to actually modify the lease asset and lease liability each year as well. So let's go in and do that. For the lease asset, it'll be equal to the old number minus the depreciation, and the lease liability will be equal to the old number minus the lease principal repayments. And we can copy this across. And so we have that. And you can see how these both go to 0 at the end in year 10. So the bottom line is that the interest keeps decreasing and the lease principal repayments keep increasing, and they will always add up to the same total, which is the cash lease expense of $20 per year here. Let's just sum that up to illustrate the point. Lease interest plus lease principal repayments, we get 20, and we'll copy this across, and you can see how it's exactly the same as the actual cash lease payments. And this makes sense because depreciation, of course, is non-cash. The cash components are the interest expense and the principal repayments. So of course, they should add up to that 20 in cash lease payments each year. If you want to then fill this out on the statements, we can link to the lease depreciation and copy and paste it all through the income statement. We can link to the lease interest here. This appears as a normal interest line item on the statements. Copy that across. And then on the cash flow statement, I've already filled in the lease depreciation here for some reason, but let's just delete that. For this one, let's link to the lease depreciation, flip the sign, and then for normal depreciation, let's do the same thing. We'll copy this across, And so we have that. And then the other items here, additions to lease assets and additions to lease liabilities, these are blank because we're not adding anything. We're assuming there's just one single lease and nothing else here is going on. So these are both blank, even though they appear somewhere in the cash flow statement. And then finally, for the lease principal repayments, let's go up and link to this. And we have now copied this across, so we have that. And I'll fix the formatting here a little bit. We don't want that border at the bottom, so we have that. So that is the treatment under IFRS. Let's now move to US GAAP and look at the treatment there. Now, to be clear, for finance leases, everything we just walked through for the IFRS treatment applies. US GAAP finance leases follow exactly what we just showed you. It's only the operating leases that are different. So the lease cannot have any element of ownership at the end. It qualifies as an operating lease, and then it uses this different treatment. Initially, operating lease assets and liabilities are created based on the same rules. So we still go in and we take the present value based on these future lease payments. So I'll enter the NPV function, and then I'll go up and take all these, and then I'll just make the operating lease liability equal to that initially, copy these down, or copy down the formatting rather, and we have both those. Now, in this case, the company will record though $20 as a rental expense on the income statement. So let's go in and fill that in. We'll link to the rental expense right here, and then copy this across, and we have that. Off the financial statements, the company now calculates interest, depreciation, and principal repayments for this lease. But the rules are slightly different, and the lease liabilities and lease assets change at different rates here. The interest part is the same. It's still the discount rate times the starting lease liability that year. So for this one, we can go in and we can take our lease liability and multiply by the discount rate of 5%, anchor that, and copy this across. This is our interest element, and I'm showing it with a negative sign because the depreciation or amortization here equals the cash lease payment minus the interest payment this year, or not really the interest payment, the interest element this year, if the lease has a constant payment each year as we're assuming. So for this one, we can just sum up the cash lease payments and subtract the interest element, and we have that. And then the lease principal repayment will be equal to the depreciation or amortization each year. So we'll set these equal to each other. And then if we carry this through and look at how the lease asset and lease liability change, the lease asset will decrease by the depreciation, the lease liability will decrease by the principal repayment. We can copy these across, and you can see how these both still decrease to 0 by the end, but they're doing so at slightly different rates than under IFRS. And in this case, with our simple assumptions, they happen to decrease at the same rate or by the same amount each year. It should be noted that even when we calculate it like this, the interest element plus the principal repayments still add up to the $20 in the cash lease payments, the total cash cost right here. So we have that. If we go down and fill this out on the statements then, and we look at the change in operating lease assets and lease liabilities, initially we're going to have a negative when the asset gets created and a positive for the liability. After that, as the asset keeps decreasing, we will take the old number and subtract the new number. And then for the liability, we will take the new number and subtract the old number. And so essentially on the cash flow statement under US GAAP, these changes simply offset each other, and we don't really see a cash flow impact from the lease assets and liabilities themselves changing. The only cash flow impact comes from the rental expense itself, which is actually the same or very similar under IFRS, where most of the cash flow impact comes from the interest and the principal repayments. The bottom line is that under US GAAP, the lease asset and lease liability for a single lease should decrease by the same amount each year, and then the company records the changes on the cash flow statement and they tend to offset each other, so there isn't a cash flow impact from just those changes. Let's now talk about leases on the 3 financial statements. And as I said in the beginning, it's actually a bit easier because companies have large portfolios of leases, and normally finance leases are so small that you just tend to ignore them in models. Operating leases are far more substantial for most companies, so we mostly care about the treatment for operating leases, and finance leases are often just grouped together with debt, and you don't pay that much attention to them. If a company is growing, you want to make sure that its lease assets, lease liabilities, and total lease expense grow in line with revenue each year. Under US GAAP, you can do that pretty easily by making the lease assets a percent of SG&A or operating expenses, and then making operating lease liabilities grow by the same amount as the lease assets each year. Let's take a look at an example for Target here. So I have a 3-statement model for Target in one of our courses, and if you look at operating lease assets, we're making them a simple percentage of SG&A, and we're saying that the lease assets and lease liabilities both increase by the same amount each year as the company's revenue grows. So you can see it's rising SG&A expense, which includes a rising rental expense here. And then on the balance sheet, the operating lease assets are linked to our assumptions above, and you can see how they're simply increasing each year, and the operating lease liabilities are increasing by the same amount each year. So under US GAAP, it's pretty simple because there aren't that many line items related to leases on the statements directly. Under IFRS, it is more complicated because we have lease interest, lease depreciation, principal repayments, and then we have additions to the lease assets and liabilities. However, in most cases, you're going to project these pretty simply by linking them to OPEX or revenue, or maybe the number of buildings or the square feet the company is leasing or the square meters the company is leasing. You will also have items on the cash flow statement for additions to right-of-use assets and additions to lease liabilities so that both the assets and the liabilities grow as the company grows. Let's take a look at an example for this IFRS-based company, Viridor in the UK. We're assuming here a lease value of £15 million for each new lease facility. The company has 5 new lease facilities each year. And then if you look at how we're projecting this on the statements, we're making lease depreciation, interest, and liability payments just a simple number based on a per facility figure. So these just increase over time. The lease asset additions and liabilities go up each year based on the number of new leased facilities times the lease value per facility on average. And on the financial statements, we have lease depreciation and interest on the income statement. On the cash flow statement, we of course add back that lease depreciation. We have lease asset additions under cash flow from investing activities, and then lease liability additions under financing activities, and then the principal repayments under financing activities as well. The end result is that, as with US GAAP, the lease assets keep increasing each year on the asset side, and then on the liabilities and equity side, the lease liabilities keep increasing each year as well. The changes are slightly different, so there are some discrepancies here, but the basic idea is the same. It's just that it's set up in a more complicated way under IFRS. We strongly recommend keeping these items separate from the normal depreciation, interest, and principal repayments because leases are not, in fact, debt, despite some of the accounting similarities. So keep them separate if at all possible. If not, you could try to simplify and group everything together, but we don't necessarily recommend that. Let's now go to part 5 and talk about the valuation impact of lease accounting and some of these changes. The first question here is, should you add finance leases and operating leases when calculating enterprise value? Should you add just one of them? Should you add both? Should you add neither of them? And then the second question is, how do leases affect the traditional DCF analysis to value companies? With the first question, under IFRS, the easiest solution is to add all types of leases when moving from equity value to enterprise value in order to calculate valuation multiples. The reason is that metrics like EBITDA already exclude the full lease expense. So if you think about it, EBITDA excludes or adds back not only normal interest and depreciation, but also the lease interest and lease depreciation, which is usually about equal to the full lease expense if the company has a large portfolio of leases. Since the EBITDA metric excludes the full lease expense, the numerator should add the corresponding liability. So it should add the finance leases and the operating leases. And they're often grouped together for companies under IFRS. Under US GAAP, you can add finance leases to enterprise value because EBITDA works the same way it does under IFRS for the finance leases. It excludes the full finance lease expense. But you don't want to add the operating leases here. And the reason is that under US GAAP, metrics like EBITDA deduct the entire operating lease expense. Let's go and take a look at this. I'll go to the lease multiples tab here. The problem is that under US GAAP, there's this operating lease or rental expense on the income statement. And if you think about it, EBITDA actually deducts this number because it's considered a normal operating expense. Whereas under IFRS, the depreciation on the right-of-use assets and then the interest expense are either added back or just excluded from the calculation altogether. So we have a different basis for calculating EBITDA here. And so as a result, we think that under US GAAP, it is better to not count operating leases as debt. And under IFRS, it's better to count operating leases as debt because it's just easier to pair the enterprise value with the appropriate multiples if you do that. So for consistency, under US GAAP, enterprise value should not add the lease liability. If you do want to add operating leases, then you'll have to use metrics like EBITDA that add back the full rental expense. Let's go and take a look at this in our table over here. You can see that under IFRS, it's really difficult to not count operating leases as debt, but under US GAAP, you can do it. It's just that the EBITDA number deducts the full rental expense. If you want to count operating leases as debt under US GAAP, that's fine, but then you have to use EBITDA, which takes EBITDA and adds back the rental expense, and then you have to pair it with enterprise value, including the value of the operating leases. So you have to take the number from our second column over here. So either method under US GAAP works, you just have to be consistent about what you're doing. Now, as far as the DCF impact here, we think it's easiest to deduct the full lease expense for companies under both accounting systems. The reason is that a DCF should be based on cash flows, and the cash lease payments represent cash outflows. It doesn't matter if a company splits them into interest and depreciation because it's still paying the same amount in cash for its leases. The problem, though, is that unlevered free cash flow normally starts with EBIT or operating income. And the problem with EBIT is that it deducts only part of the full lease expense, the depreciation, under both accounting systems. So we have a weird situation here where EBIT deducts only part of the full lease expense under both accounting systems, which means that some adjustments here are required. Under US GAAP, EBIT deducts the full operating lease expense, that rental expense, but only the finance lease depreciation. So the easiest solution is to deduct the finance lease interest and then not add back the finance lease depreciation in the non-cash adjustments. So if you go over to DCF differences here, I have an example for Target on screen. We're starting with their EBIT. There's no adjustment for operating leases required because EBIT already deducts the rental expense for them, but we do deduct the finance lease interest element here. And then when we add back the D&A, we take the total and we subtract the finance lease D&A, so we're not adding back the whole amount. And this way, our unlevered free cash flow deducts the entire lease expense for both operating leases and finance leases. Now, if you didn't do this, it's not the end of the world because these tend to be so small for most companies, even retailers like Target. We're talking about maybe a 1% to 2% difference here. So it's not that big a deal if you happen to skip the step. And in fact, we often skip this step and we don't normally include this adjustment because it's so small for most companies. But if you want to be technically correct, you can follow this treatment. Under IFRS, there's also a required adjustment, but in this case, it's much more substantial because here the problem is that the operating leases are split into depreciation and interest, and those are both much more substantial. So we think that you should start with EBIT and deduct the total lease interest and then multiply by 1 minus tax rate to get to the net operating profit after taxes. And I have an example here for this German company, Metro AG. We take their EBIT, we deduct the interest on all leases, both finance and operating leases. We get to the EBIT that we'll use in the NOPAT calculation, multiply by 1 minus the tax rate, and get to net operating profit after taxes like that. With the depreciation add back, you do not want to add back any lease depreciation so that you fully deduct the interest and the depreciation associated with it in unlevered free cash flow. And so you can see what we did here. We took the total depreciation and amortization, and then we subtracted just the lease portion here so that only the company's depreciation on its owned assets, officially owned assets, is added back in the calculation. And then since you deduct the full lease expense in unlevered free cash flow, you don't want to count leases at all in the equity value to enterprise value bridge. So for both companies here, we have a 0 for operating leases and a 0 for finance leases in this bridge. There are, of course, other ways to set this up, and some people will argue that you should count both of these in the bridge, you should count them in the WACC calculation, and they should be considered forms of capital, but we disagree with that treatment and think it adds a lot of extra work, so we tend to set up DCF analyses following these guidelines instead. I want to wrap up by talking about what you actually need to know about this topic in interviews. The truth is, you're unlikely to get super detailed or complex questions about lease accounting in most cases. Now, with that said, there are some countries and regions that are known for asking very technical questions. Germany would be one example where Banks there are notorious for asking very technical questions that go beyond what you would get in London or New York, for example. And if you have more experience, you've worked with companies where leases are very important, anything could happen. But I would say in general, this topic is not going to come up in super granular detail in entry-level interviews. So my recommendation here is to know the basics. Know how assets and liabilities for leases get created on the balance sheet and how they change over time, how they decrease over time for a single lease, but how if the company keeps signing new leases and growing, they will also tend to grow with the company's revenue. I doubt that you will get multi-step interview questions about this topic though, because it does tend to be more of an on-the-job issue. But again, depending on your region and your level of experience, anything could happen. So be prepared and be conscious of where you are interviewing and how they're going to look at your experience so far. We're at the end, so let's do a quick recap and summary. We started out here by discussing operating leases versus finance leases and how mechanically they're very similar in terms of the cash payments, but finance leases are separated by a few potential ownership options at the end. Then we talked about the treatment for finance leases and operating leases under IFRS and the split into interest, depreciation, and principal repayments. We looked at the US GAAP treatment of operating leases and how it seems simpler on the surface, but it's actually somewhat confusing because they show the rental expense, but they don't show the actual interest, depreciation, and principal repayments they're using to modify the lease assets and lease liabilities each year. Then I showed you a few examples of leases in real life on 3-statement projection models and how you can normally project these line items with fairly simple percent of revenue and percent of operating expense estimates. We looked at the valuation impact and how under US GAAP, you have some leeway about how to treat leases and enterprise value, but you have to be consistent. Under IFRS, it's easier just to add all leases in the enterprise value calculation for multiples. And how in the DCF analysis, we think it's best, or at least easiest, to do what we recommended and to deduct the full lease expense from unlevered free cash flow and to not count it, not subtract either operating leases or finance leases in the implied enterprise value to implied equity value bridge at the end, although people will differ about this and there is some debate about what to do. And then finally, for interviews, you don't need to be an expert on this topic, especially for entry-level interviews or internships or things like that, but you do want to know at least the basic points, and if you have more experience or you're interviewing in a group or region that is more technical, be prepared for anything. That's it for this tutorial. Hopefully now you have a better idea of how leases work on the financial statements and how to think about the accounting for leases and how it affects the valuation and DCF analysis.